Good afternoon, and it is not usually that we have a 3 o'clock webinar here at BizNews. We like to do it at noontime, but the reason why we're doing this one is that OrbVest is a company that invests in the United States, and its CEO, who we haven't seen for a long time. Martin, Justin and I were talking beforehand. Justin Clarke is based here in South Africa. Martin is based in New York City, and it's a reasonable time now of the day for you.
It is. Thank you, Alec, for having me on the webinar. It's 8 in the morning, and it's a lovely, crisp morning.
And I like the background. Are you guys together? Are you also over in New York, or is this AI playing its bit?
It's not as it seems, Alec. It's AI.
Okay. Right. Well, we're going to be talking all about OrbVest for the next hour. The intention is to share with the BizNews community some, well, I suppose, significant changes to the way that OrbVest is going to be run in the future. It's been a long journey that we've had together. And Martin, maybe for those who don't know you, would you just give a little bit of background into how you became involved with OrbVest, indeed, how you became involved here with us at BizNews, because we have been going for a few years together now.
Yes, thank you, Alec. And so I think the first thing is, I'd like to introduce myself and say I'm a proud South. I lived in South Africa my entire life until immigrating to the US 6 years ago to essentially lead this initiative, which is OrbVest. It was during my immigration process that really we had formed the company, which was a strategy to help South Africans and people around the world invest into US real estate and earn dollar dividends. And during this journey, prior to that, Justin and I met each other. We both personally wanted to invest in real estate ourselves. And that's where we were also seeking our next entrepreneurial opportunity. So that's how we ended up moving forward with OrbVest, and hence meeting yourselves and your fine community.
And Martin Freeman is the chief executive of OrbVest, based in New York. Justin Clarke is the resident director here in South Africa. But you've stayed with us, Justin. Both you and Martin have been to BizNews conferences. I'm glad you're joining us again in Hermanus in just a month's time. Maybe we need to get Martin over in the near future. But there's quite a few changes. We did meet a few months ago in Cape Town, and you took me through them. But I guess you've got a presentation. Best thing to do the presentation in just a moment. Before we get there, though, we need to make sure that we can keep this interactive. My colleague Stuart Lohman is also on this webinar. He looks after the tech side of these presentations. And Stu, maybe you can just tell us or tell our community how everything works as far as giving the questions is concerned.
Excellent. Thanks, Alec. Quickly, just before we get there, if you can hear my voice and see me on screen, there's a little half-five button on your control panel. If you can give me a few half-fives, there we go, Alec. That's always an easy one. And as Alex said, we do like to keep it conversational. On that same control panel, there is a little Q&A button. Not the chat button. Please use the Q&A button. If you put your questions in there, I know Alec will pass them on. He also likes to keep it to first names only. So don't worry about your full name being displayed. But all good this side, Alec?
Yeah, and we cannot overemphasize that. There is no way that your identity will be disclosed to anybody watching this video sometime in future. And we will just give your first name. So it's be very hard for anyone to work that one out. Justin, over to you, sir.
So, Alec, I think let's go back. We haven't spoken at all about the changes yet on a webinar. So I think that, we've been through this journey for the last several years since the inception of OrbVest, certainly in 2018. But, the hypothesis in the beginning, if you remember correctly, was that we sat really on this side of the ocean. We identified that healthcare was a really good space to invest in. And effectively, we invested in buildings that were operated and run by third parties. And we believe that investors would like to actually, check out and, what can I say, kick the concrete of each building that they invested in. So each building was effectively offered as a syndicated single asset. And I think that, to put it in a nutshell, we've effectively outgrown that, and for a number of reasons. But I think let's just go through what we have decided to do and what's got us to this point. So first of all, our core portfolio, in other words, the buildings that we have done since OrbVest predominantly, it encompasses around 30 buildings. We're sitting in about 9 states. The value is around about $250 million at cost. And the interesting thing is we're at an occupancy of over 90%. And I think that is really super interesting if you consider what's happening in the US with the office market, that people often confuse medical and office. But I think that is super interesting. And the incredible thing is that we've got 150 medical or healthcare tenants that are effectively professionals that are your tenants in the buildings. Many of them are what we call credit tenants. In other words, they've got high credit ratings. They're large companies that have multiple offices across the states. And the other thing that's super interesting is the WALT. In healthcare, we always have these long WALTs, and our current average of over these 30 odd buildings is a 5-year WALT, which is a nice, juicy, long-term income. So effectively, you know what your income is going to be for the next 5 years.
What is a WALT? Simple terms.
Good. A WALT is just your weighted average lease term. So I guess take the weighted out, and you can just call it your average lease term over the portfolio.
So I'm going to just jump in here. And so what it really means, Alec, is that, when you buy a building, if the average duration of your leases is 5 years, it means specifically in a medical office building where you got 10 tenants, it's very predictable, your income over the next 5 years, subject to obviously whether your debt or your expenses are also similarly stable or fixed. And most of our buildings have fixed debt. So it's a very predictable income or revenue stream.
5-year average lease for the tenants that you've got in the building. That gives one a lot of confidence. But I guess the other thing, and it is important, Justin, there's a lot of concern at the moment about the commercial property area, is that you focus exclusively on medical properties. That probably now, Martin, is that differentiator must be something that you're delighted that you stuck with.
Absolutely. So I'll jump in here and say that from Medical 26, when we first met you, that was the last real building that we moved into where we were chasing office buildings, conversions, high risk, high returns. Because in any kind of real estate asset class, the higher the return, the higher the risk, we always say to people. And it was our view that we started to really talk about, what do people around the world want? They want stable dollar dividends. And predominantly in healthcare, it has proven itself, specifically through COVID, and continues to be a shining asset class. And more larger players in the US are stepping into that space. And that's one of the reasons why we've embarked on this change, and we'll explain how that journey unfolded.
Quite important that we just stop there for a minute, because the BizNews community I've had a couple of emails from people saying they're unhappy about certain of the properties which haven't done well, and I'm sure you're going to address that in a moment. But as far as we're concerned, as far as our community is concerned, we have been involved. We've had a relationship with you from number 26, from Medical Property 26, and from there onwards, I guess that's all we can really talk to. But from there onwards, things seem to be going pretty well.
I think that the description I'd use is probably better than pretty well. I think that we are enthused at the performance. I think we're very proud of what we've achieved. And when you go to the largest players in the US and they give you a pat on the back in terms of what you've assembled and what you've done to date, it really is a fine vindication. It's the journey that got us to the point that we'll talk about later in the webinar, because life is always never a straight line, specifically in any business or even in real estate. But certainly it's one of the reasons that drove us towards the formation of what you'll see tonight as Accretive.
Thank you, Martin. Thanks very much for that. And of course, everybody knows that there's no upward path. In fact, if everything was up like that, then you'd be a Ponzi scheme, wouldn't you? Okay, Justin, sorry for interrupting, but I think it was important that I understood what WALT is, because if I don't know, you can be sure there are a few other people who don't as well.
Yeah. In the States, as you know, Alec, everyone gets lost in acronyms. So we could all have a whole webinar on acronyms. But anyway, I think just coming down to it, we will return 100 million to investors. Well, this is actually in 2023. So effectively, we've already done that, in excess of 100 million to investors in 2023. So I think we're not tiny anymore. I think we're starting to do a decent job. But Alec, and to one of the emails that you did receive today that you shared with me, we've completely outgrown this kind of single asset, putting everyone into individual buildings. And the thing is that no one really is going to go to the trouble of doing proper diligence on the building that we put forward to them. They look at the picture on the brochure and they say, sounds good, you guys look great, we put our money in. So ultimately, the people turn to us and say, you guys actually, you tell us what to invest in. And so on the basis of that, we have said that we need to put all these things together, like we have done successfully with OrbVest Diversified Holdings. You'll remember that product. And then, we create one effectively group of buildings, which we call a fund, and we lump them all together. And that is how it's done traditionally. The beauty of that, Alec, is there is obviously significantly less capital risk. And of course, you get a nice blended return, so you don't have the ups and downs. And I'm going to come back to that mail just now that you had. This was a dividend that wasn't paid on one particular portfolio of buildings in Atlanta that we have, where we've just had a massive celebration because we've signed several 10-year leases all at the same time, plus two Veterans Association that are government leases in two of the buildings in the portfolio. But there's a problem with that, because you now need to pay the commission and the TI. And normally we have a facility with the bank, but because of what's going on with the banks at the moment, they now want to interrogate that facility and reconsider it, which causes a delay, which causes a bump in your returns. And of course, this is why you don't want to do single buildings.
Justin, if I can jump in there and just also mention another acronym. A TR means a tenant installation allowance. So when your tenant in any building signs, or for anybody that has a business and you sign a new lease, the first thing you ask your landlord is, well, what are you going to give me? I need to repaint my walls, I need to put down new carpets, etc. And obviously with significant long leases like that, with big spaces, it becomes a large number. And that's the reason why single buildings are fantastic. We've enjoyed the ride, but there is the odd bump along the way when you have situations like this, but it's situations that create value. And if you're part of a larger portfolio, which we'll discuss in more detail now, you are less likely to feel the movement on one particular building out of 30.
Thanks, Martin. I think just now you'll talk perhaps a little bit, or you might mention that we spent some time at the beginning of the year in the US on Wall Street visiting various institutional investors, Alec, and it was an incredible journey. But effectively, the message was, we really want to be in the healthcare space, but we can't invest in single buildings that are held ultimately in a place called the Seychelles that we've never heard of before. We want the structure to be in the US, we want the fund in the US, we want the OpCo in the US. So we will absolutely provide you with the growth capital that you need, but you need to fix these things first. So,
well, I'm going to jump in here, if you don't mind, and take Alec and the community on a journey. So what actually happened was, about a year and a half ago, we engaged one of the largest healthcare advisory firms in the US. We went out to 175 of the largest players in the United States, who have all got significant multi-billion-dollar portfolios. And we ended up engaging on a consistent basis, Justin, myself, and the team, with over 40 of them. And as Justin said, they really do have a strong focus at the moment on healthcare. They all want to climb in. The issue is they want to find the right team that they can partner with, because they don't do it themselves. They need a backer team. And so it got to the point where each of them, one by one, was saying the same thing. And it's the same as if you were the Springbok coach and you keep getting the same playbook, it becomes a bit of a no-brainer. So that was where we realized that it was clear going forward, we needed to put things into the portfolio and certainly position ourselves for significant growth going forward, which they themselves are excited about. And I've said the moment it's done, come talk to us again.
Thanks, Mart. So just moving quickly through this, Alec, this is what we've done, or that is in the middle of being done at the moment. We've been to all of our investors, in excess of 1,000 that were in the individual buildings. We've got a very, very strong mandate to move forward. We've delisted from the merge, the Seychelles Stock Exchange, each one of these things. We have formed AccretivPLUS Healthcare Portfolio, and we are consolidating those individual interests into the one company. We are in the process of establishing a Jersey fund, which is Accretive Healthcare Real Estate Fund 1. And we are consolidating all of the underlying buildings in the US into the core fund, if you want to call it that, Accretive Med Healthcare Real Estate Fund 1 in the US. So all of this is all happening at the moment. The ticks are things that are predominantly finished. We have built in liquidity events. As you know, one of the issues with a sort of a syndicated product like ours is you're locked in for 5 years. So, although it is still pretty much a fixed period investment, we've created little windows over time, similar to how it would work in a REIT, to allow people to exit. And then, of course, we are in the process of establishing a proper US OpCo made up of people that can really move the needle in terms of getting this portfolio to be super valuable in 5 years' time. So yeah, let me just quickly get you into AccretivPLUS, what we actually are offering and what the benefits are. I think that, first of all, this is really just a turbocharged version of OrbVest's diversified holdings without all of the multiple entities in the Seychelles. So we have a lot of our investors that are very happily invested in ODH. It has provided a consistent distribution of 7%, I beg your pardon, over the period. And so that is really one of the drivers that got us to do this. Simplified structures, we're eradicating 20-odd listed companies, and the impact of that is around about 2% on the overall IRR or the internal rate of return on those buildings at the end of the 5-year period. It's significantly better from a risk point of view. Obviously, you've got diversification now. So if something happens to one building, it's effectively a rounding error on the overall portfolio. There's portfolio debt. In other words, you can get debt over multiple buildings, which decreases the risk for the bank. And then, of course, the bank is much happier to give you better terms. We've always needed bridging in order to take down buildings. In other words, buy buildings quickly. Remember, the quicker that you can strike, the better a deal you can do with the seller. You get insurance across your portfolio, which, of course, helps you to deal with the high-risk areas like the hurricane areas like Florida, where we've got fantastic buildings, but with very expensive insurance. Obviously, you get a blended insurance premium. Cap rate compression, what this means effectively is I'm going to say the BlackRocks of the world, which might lead you into who we were talking to in New York, but the BlackRocks of the world can't go around and buy individual buildings. They want to deploy a minimum of 100 million at a time if they want to buy a portfolio. So they're looking for portfolios in excess of 100 million that are already performing, and they're prepared to pay a premium for them. And that's what we talk about cap rate compression. You get a much better price the bigger the portfolio. Liquidity, obviously, we've got these off-ramps that I mentioned earlier on. We are intent on taking back the property management because we want to make sure that we're very, very close to our tenant. And that's what we talk about with the OpCo in the US. Compound interest, you can now reinvest your dividends, which of course helps you to grow your yield. And the fact that we can get institutional capital, really trying to move as quickly as we can. We have made our first acquisition.
Just for those who might be coming to this webinar for the first time or discovering OrbVest for the first time, the reason why you had individual buildings in the past and this complicated structure that you're speaking about with 20 different listed companies, if I understand correctly, each building you identified a medical property in the United States. So you wanted to get hard currency, you wanted a medical property, and to invest in that medical property, you invested through a separate listed company in Seychelles. Now, if I understand correctly, you're now at a stage where you've got so many of these buildings that it makes sense to consolidate them all. You had a first step towards that with ODH, which I know there are many members. In fact, I think Magnus Haystack might have been instrumental in nudging you in that direction, because Magnus said he likes OrbVest a lot, but he's a bit worried about the lack of diversification in buying into OrbVest properties. So you then created ODH. If I understand correctly, is this like a super ODH where everything really just gets put into one pot?
In fact, I'll jump in here and say that is absolutely correct. And one of the things that also arose was, on a monthly basis, we have a asset under management meeting. And it was in the early part of last year. And I said to Justin, why is it we never talk really about ODH? And Justin's words were, it just works. I never get any emails. We pay out the dividends. It just is so smooth and simple, as opposed to each individual building. Every quarter, somebody wants to know what's happening with that tenant and what's happening with this and what happened with the expenses. And it's the minutia versus the macro level. And it's for the reason I think a lot of people have a blended portfolio, even in the equities market or anything else you invest in. Justin, if I can jump in and talk about this. This is our latest acquisition in December. We acquired this building. It is in the wonderful growth city of Palm Beach in Florida. It is at a cap rate of 8%, which is the way that you acquire a building. So if you bought a building at a 6% cap rate and it was $10 million, you would expect to get $600,000 return. And if you bought it at an 8 cap rate, you would expect to get $800,000 return in the year. The building is 100% leased to healthcare providers with long leases. And so you can see how the market over the last year and a half has dislocated. And with higher interest rates, higher cap rates, it means that this building, which was trading at a 6 cap rate, has now moved out to an 8 cap rate. It's a fantastic acquisition. And it's almost a no-brainer that within 2-3 years, when interest rates go back down, which they will, the cap rates will go back down and there will be enormous value creation. These are the kind of assets that, Alec, we continue to acquire in the US.
That's it, Alec. That's all I need to take you through from an introductory point of view, and we can move back to your questions.
Well, let's just spend a little time on Medical 43. Is that going to now be in the pot? It's not going to be an individual. You can't invest into Medical 43. It's going to be part of the overall, or is that correct?
Yes, and we'll continue to grow the number of deals and the number of buildings within the portfolio. Our initial goal is to move up to 500 million. And then obviously the ideal scenario would be as we get to $1 billion. But either way, our exit strategy is within 5 years, we will aggregate, grow, consolidate, and improve the portfolio, and then look to either sell it to a large REIT in the United States or become a listed REIT ourselves. That's the exit strategy.
Okay, so the BizNews community members who've been with you, they invested at a much stronger rand than we are today. I can remember when the rand then went to 16, and we were thinking, oh, maybe it's gone too far. My goodness, we're at 18, sometimes 19 at the moment, and many of our tribe were investing here in the 14s. So there's been that uplift. The other uplift, though, I guess, has been with these hard currency dividends that have been coming through. But now, if you invested in Medical 30, just use that as an argument, because as you say, the BizNews guys got involved from Medical 26. What happens there when you put them all together? How are they going to be treated?
So, Alec, I actually just want to go on a journey back. I remember you and I discussing on a webinar When is the ideal time to invest? And we spoke about you can't guess the rand. You just have to average it out. Sometimes you'll invest every quarter at a higher rate, and sometimes it'll be a low rate. And in those days, you're quite right. We were talking at levels of 14 to 15, and we said, what happens if the rand goes to 17? And it's incredible to look back now, what a fine investment it's been for them. For each of them individually, they all become part of the accretive portfolio, which is ultimately a AccretivPLUS in the Seychelles that then invests into Accretive Med in the United States. And they then get their shares pro rata issued into the portfolio. And they still continue to get their consistent dividends like if they were in ODH. And so that is our goal. And as we grow each building and as we grow the net operating income, which is known as the NOI each year, so the value grows. Why does the net operating income grow? Because every year, like anywhere in the world, your rent goes up. So your income continues to go up. And so that is the thesis around healthcare medical buildings, which have shown consistent growth for literally over a decade.
Adam's got a question. He says, are all the old single building investments being rolled into AccretivPLUS? All of them.
So the answer is no. The answer is all the investors have voted to convert it into accretive. However, this is a performing medical only building and of portfolios. It's a portfolio of these buildings. And so provided they meet the appropriate criteria, that they can produce the appropriate dividends and they meet the investment criteria, then they are included. If they are not, then they won't be. So for example, we have one building where one of the large players in the US said, what is your plan on this building? And we said, we're going to convert the remaining 2 or 3 tenants into medical. If at that point it works out, great, it's in the portfolio. If not, it stays out. And that is really the thesis around it, because the larger players in the United States that want to back us with significant money to grow are very particular in terms of a clean portfolio.
There's a tough one here from an anonymous attendee who says, we would like some feedback on the Honan, Honan debacle, and if there's any chance of saving any of those buildings. It's all good and well to punt the new ones, but many of us investors might lose everything.
Yeah, so I think it's a good way to talk about the past and the fact that life is not always a straight line. And so when Justin and I met each other, we actually came through a journey where we inherited a relationship and inherited some buildings. And I'm going to hand over to Justin now to talk about these particular buildings.
Yeah, I think there's a lot of detail here. So let's just start from the top, Alex. So yeah, correct. The sponsor's name was Richmond Honan Group, as your anonymous brought up. There were a couple that were done, as Martin said, prior to us effectively inheriting them with the intention of taking over the asset management. And then we continued to do business with this particular crowd. And again, I go back to the initial way that the hypothesis on which the business was effectively formed, and that was that we would find somebody who was a substantial player already in the industry, and in this case, Richmond Honan was. They had a massive balance sheet. They have a really impressive set of buildings, and they had been operating for 37 years, Martin, I think. And so yeah, so we did, the last one we did with them was 26, and I think that to kind of conceptualize it, he and by extension us walked into a absolute perfect storm. So I think there's probably 5 factors that intertwined to create an absolute chaos that we've spent the best part of the last year. And Martin, I'm saying, probably 80% of your time has been spent trying to resolve these. And we'll go into the details of what we've been doing to try and resolve the situation. But, I know that we try and stay away from passing blame onto COVID, but you've got to understand that the office sector and many of these iconic buildings that Honan had already acquired were in the development phase. So that means that they were moving the office tenants out as their leases expired and pulling in healthcare tenants. And so they had leases in hand in most of these circumstances. So, I think that is, we absolutely have to understand that that had an impact. In fact, that Medical 26 Dallas building, we took transfer of that the months before COVID. So, and we have lost a couple of floors of office tenants that have subsequently vacated that building. I think the timing of COVID was particularly bad for the sponsor, as he had also agreed a schedule with the lender, with the bank, that would provide capital for the conversions. So when COVID sort of started to subside and he went to the bank for funding to install his tenants, of course, there were no funds to do so. Healthcare tenants who were moving into the buildings, and again, I referred to that Dallas building. There were 3 leases that were in process when he acquired the building, and all of those 3 leases backed off for the reason that they just want to wait and see what's going to happen. They'd rather stay in the safety of their hospital and not move out into private practice effectively until the storm settles. So you immediately lose those leases. And then, of course, the Fed cycle. And once again, I suppose the Fed cycle happened because of inflation, which happened ultimately because of COVID and the aggressive hikes in interest rates, which have played absolute havoc with the capital markets, Alec. And I mentioned that, the Med 24 building, that we had a pre-agreed facility to install tenants, and they trying to renege on that. So, it really has caused a lot of chaos. And I think that that has really put the nail in the coffin for all commercial buildings. And then finally, we realized that this guy, when his back was against the wall, he became a bad actor. And, people do behave badly when they're in a corner. And I think this was really the nail in the coffin for the sponsor. He couldn't service, he couldn't maintain the buildings. He provided inaccurate information. I'm going to leave it at that, to the banks and to us. And basically, his entire organization has collapsed. So, all of these things kind of loop back into each other. But I think, Martin, you have been in very deep discussions with the banks. Maybe you'd like to pick it up from there.
Thank you, Justin. Yeah, I think that the one key thing for me, Alec, is why do people invest with you? And for me, it goes down to 3 things. Number 1, you've got to have that trust. Number 2, you've got to have the respect in terms of disclosure. And number 3, you've got to be able to go the extra mile, not just in the good times, but also when things get tough. And so what have we done? So we've done 3 key things. The first thing is that we have started to engage with all the lenders and the banks to try and get the buildings back. Why? Because we're the most likely, most logical, credible candidate to get these back, because all the banks and the lenders acknowledge that we were the unfortunate party that ended up in this relationship. The second thing is that we have obviously engaged with all of our investors on a quarterly basis to try and make sure that they are kept abreast. Obviously, it's very difficult. It's a very long, slow process in the US, which I am learning. And probably the reason you haven't seen me at your annual events, because I'm being kept busy. And then the third thing is really just to make sure that with our legal team in the US, we seek all alternative options to try and get our hands back on these deals. Because make no mistake, these buildings are in good locations. They are great buildings. And it's purely about whoever manages to get their hands on them will be able to restore the value and recreate value if they get it at the right price. So that's what we've done in the interim.
Okay, well, thanks for spending some time there. It's always good to clear the air as much as possible. Michael wants to know, what happens with investments 2 or 3 years ago that were invested in individual properties? Would the time period still remain the same? I.e., now that Accretive is going to be bringing them all together, do you start your 5 years again from here?
So if I can jump in and say the following is, any person in real estate, I think pretty much anywhere in the world up until almost now, should not be trying to sell a building at the moment right now, because you want to sell at the right point in the cycle. So right now, as we know, and it's not me, it's the Fed in the US, you can see they have the monthly updates. They've indicated 100% they're going to start bringing rates down. And when rates come down, then the values of properties go up. So what I would say is that even if a building was likely to be sold, I'd say to someone, wait. And off the back of that, Alec, our envisaged scenario is that we've got a very clear plan for the business and for new investors and for existing investors. And so my advice to all of them is, our plan is within 5 years, we will sell the entire portfolio. We really do believe that there is significant upside. And that's why investors are investing with us, to get not only their quarterly dividends, but also their capital gain at the end. And so, with us growing the portfolio consistently over time, there's no reason why we shouldn't achieve that. The next part of the story is, in terms of even new investors coming in, they get to join and enjoy that growth also, while still earning their dividends. So I hope that answers the question.
Devin is a member of the BizNews community, and his question is, the accretive concept makes sense. However, of the 11 buildings that I invested in, only one has consistently achieved target. How are you going to ensure that the accretive portfolio achieves target, given that the reasons cited for not achieving target are always seemingly out of OrbVest's control? The argument that returns are not a straight line no longer applies, as this has been going on for a good few quarters now, and he says getting worse. By the way, I started investing at Medical 26.
Justin, you want to take this one?
Yeah, I think Devin, I think that, and I'm trying to picture which deals you're in that are underperforming, but the idea is that over a lot of the portfolio, we have had softer leasing conditions, and I think I explained that just now. So we were overambitious with our lease up. I think we have resolved that, and I think I also mentioned earlier on that we were having a very good period of signing leases at the moment. So I think that is being resolved, but I would like to accept the blame, but there are economic conditions that are sometimes out of our control, and we did underestimate a little bit in terms of lease up capacity. The other thing was expenses. We try and go for triple net leases, but not all of our buildings are triple net. That means that all the costs you can push on to the tenant. When you have inflation, increasing insurance, particularly in Florida, and increasing utilities, unfortunately, if you don't have all your tenants on triple net, you have to absorb some of those costs. So, but those are relatively small, and I think that when you're saying not performing to scale or to the original plan, I think they're probably doing a 5% as opposed to a 6.5% or something like that. So I think obviously there are reasons why those buildings are performing, and we're working on those to try and resolve those issues. But by putting them in the fund, the efficiencies, and I think this is what I tried to allude to earlier on, and just by getting rid of all of those inefficiencies, we can improve the return and get it back on schedule. And we can get our focus onto doing the right things, Devin. And the right things are spending our time working on the buildings and not managing many $1,000 investors, which is where we have sort of ended up, where we spend a lot of our time focused on the investment community and not so much time, not enough time spent on the building side. And this kind of realigns us.
Justin, if I can jump in here also and say the following. Alec, when I first started, I remember in the days just before I started this journey, I ended up buying a house down in Atlanta, a small little house, and I was getting 9%. And that's what got me on this journey. I couldn't believe it, like 9% in dollars. That was amazing. So when Justin and I came into OrbVest, we said we want to do 8 to 8.5% cash dividends. And at the time, everyone said, listen, you mad. Like, that's sometimes if it's too good to be true, it's too good to be true. And we actually managed to live on most of our buildings 8% and above. And then I think over time, what happened was we started to realize, listen, it's a bit ambitious because things do happen. And our mantra at the moment now is anywhere between 5 and 8% is still a very good solid return. I think some of the buildings are slightly lower, but bearing in mind, if you compare healthcare assets compared to any other asset class in the US, most of them are down to literally no dividends or literally very small dividends. And so I think we are performing exceptionally well. And I think it's just a function of the market at the moment right now. I mean, I am in the US myself. I personally will struggle to find an asset class or an investment where I personally can get 7% cash dividends. So I think we need to take it in context of that. And I think for South Africans, the other thing I want to highlight is for those that have invested, when you look at it relative to the depreciation in the rand, and you take that factor into account, it's, in our opinion, a solid return.
Maybe that's something that you guys can do some numbers on. It'd be very interesting to see that when you did the initial targets, I understand what you're saying, I think, that you were over-optimistic on the targets that you were looking at. And Devin is now saying, why aren't you reaching that 8.5% or so? But if you kept the rand at the same level, and then you took that, in other words, your return in rands, it'd be interesting to see whether you have achieved those targets or not. I guess I would bet that with the way the rand has collapsed, you probably have. And of course, as we do as investors, if the rand falls out of bed, well, of course, we'll take credit for that. But you guys should have actually given us the dollar return. So it just is. It's just relative. But I think for context, it's not that you gave a target of 8% and you made 0. It's you gave a target of 8 and you made 5 or 6.
Yes. Yes. And that's the point, is that, you know, when you put everything into a portfolio, I just want to expand on some of the things you unlock. Number one, it's a no-brainer. When you've got a larger portfolio, banks will give you a better rate on your debt because they've got their risk spread. When you have a larger portfolio across 9 states and 30 buildings, your insurance improves. So everything improves. And most importantly, I want to explain to everybody, we are managing at the moment now, our poor CFO, whose name is Lo, he manages 140 companies on an annual basis. The amount of efficiency that's unlocked when you pull it all into one entity is enormous. So we're excited about that, and allows us to focus on really being able to give a single update on a quarterly basis. And that's what I think is very exciting for investors. And when I talk about investors, Alec, this is not just retail investors. It's institutions, family offices in South Africa and around the world that have all said the same thing to us. You know, you can't come to us with a single building and tell us we've got 60 days to close. It just doesn't work that way. It takes us 90 days to do a due diligence on you. And so what this does is it allows them to come in on a joint venture basis and to partner us and to grow alongside us whilst we go out and get these great buildings. But the opportunity I want to talk about again for a second. Remember, all the deals have and the buildings have got a lot cheaper based on interest rates. We want to go out and acquire a whole chunk of them. And when interest rates move back down, which they absolutely will, and they are going to, you can see inflation's already back to 3%. What happens is your value also improves significantly. But we don't bank on capital gain. We look towards dividends in this portfolio. Justin, I think it's important we also state to Alec and the community that we will still do now and then value add opportunistic deals. But those one-off deals are not for people seeking dollar dividends. Those are deals that people will go in, they will invest, there will be no dividends, and they'll be going for a pure value play. But that's to a more sophisticated investor and separate from this discussion. Still under the Accretive banner, but in a separate subsidiary.
A very high minimum investment to make sure that it's only sophisticated investors, I think, Alec.
We've got quite a few questions to get through in the last 15 minutes. ND has said, how do we know whether the building we're investing in will be included in the Accretive portfolio?
I see there's a few similar questions there. I'll get that one. So, guys, process is we went to the investors in the middle of the last quarter. So by November, we had the go-ahead to move on with the consolidation. We had to get the dividends for Q4 out, which have all now been dispersed as of today. And we will then start with the consolidation. Initially, we're doing 5 properties in phase 1, which is this quarter. And then we will look at the next 5 in the next quarter. As far as a notice is concerned, we will send out a notice in the next day or 2. It'll be in the form of a CEO update, which will go to everybody, all investors, and we will specify what's going in what phase. And incidentally, some of the buildings that are what we say not performing to the correct return that is required for inclusion into Accretive have already been fixed, but they have what's called a rent-free period, because when you sign a lease now in the US, because of the competitive environment, the tenant wants a 3-month or even a 6-month free rent period. So some of those rent periods are already burning off. So we know when those buildings are going to be profitable again. So yeah, I hope that answers that question. And that was also Johan's question below him, Alec.
Yeah, Johan wants to know which buildings are non-performing and will be excluded. How will individual investors sell them and then use the cash to buy into Accretive?
So Justin, each one of those buildings of the 30 have gone through a process with their each individual grouping of investors. And that's maybe where we underestimated the workload, Alec. We thought we'd have it done in 4 months. It's taken us 6-7 months. We had to go through every single building, special AGMs, EGMs, presentations, packs, DocuSign votes on every single one of them. And so on each one of them, we've mapped out to those individual investors what we intend to do with that building to rectify it, because our goal is we want all of them in the portfolio. It's just the timing of when we can get them in. So for example, if you need to bring in 1 or 2 leases and you need to do something around an expense item like the insurance, then that gets you now to the right dividend. And if it's at the right dividend and the right leasing percentage or occupancy percentage, then it immediately goes into the portfolio. So that's our plan on all the buildings, Alec. Regarding the non-performing older buildings, just to make it also very clear, those are not part of Accretive and those are not medical buildings. So no matter what happens, they will not be part of it.
So as long as you're in a medical building, the intention is that it will become part of Accretive at some point in time. But
yes,
as you're only putting 5 in in a quarter, you can't now say what the other 25 are, because you'd just be going through a very long list. I'm sure what we can do is we can communicate which 5 buildings are going to be going in as they go in there. Here's a specific question from an anonymous attendee who says, when will Medical 37 be incorporated into the consolidated Accretive Plus?
Again, in terms of the specifics on each building, what I would say is that we have a plan. It would be unfair to communicate each separate building with everyone online today. Each one of those buildings, we have an update on a monthly or quarterly basis. And so they're welcome to reach out to Justin directly, who has a clear plan of action together with our CFO.
Rivera wants to know, what is the worst case scenario for investors in bad buildings? They lose their money.
Alec, I'd like to talk a little bit more about those because, you know, the one thing that has happened in our favor is those bad buildings or those older buildings, we were supposed to have them completely off the scorecard and the game over pretty much a year ago. And as circumstance has panned out, with the interest rates and the chaos caused in the office space, most of those banks do not want the buildings back. They, in fact, have come back to the individuals involved and said, can we work together? Now, it's a very slow, long process, but just to give you an idea, that from March last year, if somebody had asked me to put a bet on it, I would have said by July, August, they were gone, resolved, some way, shape, or form. Well, we're in January, February, and none of them are resolved. But in the last week, one of those particular buildings, there is a very strong likelihood, and I don't want to jump the gun, that we will get them back, that particular building back at a ridiculous discount. And when I say a ridiculous discount, I mean a phenomenal price to be able to restore a lot of the value back to the investors. So we remain completely focused with our eye on the prize, which is get them back, restore value, and do what's possible on those buildings. So I can't go into further detail other than to say every single one of them has their own journey and a story, because unfortunately we are not the major role player. The lender is, or the ground lessor, the person who puts the debt under the ground. It's another instrument in the US. And they clearly are in a difficult position because they don't have many options, because the market is dictating a very, very low price for those kind of assets. And it's just taking them time to readjust and realize that they're writing it down each month. And eventually gets to the point when they say, fine, let's do a deal.
Mm-hmm. Adam's got 2 questions. The first is, how much transparency will investors have in individual properties making up the portfolio? And will the properties be independently valued to determine the entry price into AccretivPLUS?
No, the reason why is because in the market at the moment, there's a basic cap rate. So for medical office buildings, if it was 7% and everybody was going in at 7% and it then went to 7.5 or 8, you're all going at the exact same formula. And it's all based off the net operating income. So every single building, even if I go out and buy a brand new building tomorrow, it's the same thing. You take the net operating income, you divide it by cap rate, and that's the price of a building. So it's fair across the board for all of them.
Sadia's question is, assets under management, $250 million US, dividend 100 million Rand. The ROA seems quite low.
Well, I think just to clarify that, we said we returned a minimum of 100 million Rand. We didn't say it was exactly 100 million Rand. And so I think that when you look at each of the individual buildings, you'll see that we're very much within a very good range. Some of them we've newly acquired. For example, Medical 43 is part of the portfolio. We haven't listed it yet. We haven't paid our first dividend yet. So these are the anomaly. But I think that what you'll find in general is that if you look at the overall community, the buildings, the feedback we've received on our portfolio, it's been very, very bullish. And we remain really focused on growing it going forward.
But just to clarify that, Medical 43, that's not going to be separately listed.
No, that is part of the portfolio. In fact, it was actually the seed investment into the Accretive portfolio. And hence the reason why we were under so much pressure, because we were buying the building and we needed to have the structures in place in order to put it in. By the way, I just want to tell everyone a story about that Medical 43 and to give you a feel, Alec, of what's happening in the world of debt, which no doubt is in the US, but also in other countries. So at the start of December, we got a quote on our debt. It was 7.4%. Between the start of December to the middle of December, it had already realigned back to 6.9. At the end of December, when we made the acquisition, we got the debt at 6.6%. Now, that is a dramatic change. And when you think you're buying it at 8% cap rate and you're getting your debt at 6.6 or lower, you've got a nice margin on day one already to generate returns.
An anonymous attendee asks, US commercial real estate has been hit by a surge in interest rates and the pullback in lending from regional banks, which we know, which potentially could spark another banking crisis. What's your thought on that?
I absolutely concur with that. I think that the contagion is ring-fenced to risky asset classes. Office, no doubt, is taking an absolute hammering. By way of an example, we spoke about Medical 26, the one that some of the investors were in. It was our last, what we call office to medical conversion. There were two tenants. And just to give you a feel, Alec, one of them is New York Life. It's one of the largest insurance companies in America. And they had 2 floors in the building. Well, when COVID hit, they've been there forever. Post-COVID, they said, we only want 1 floor. We want to give up the other. We've got La Madeleine, which is one of the largest logistic or food companies in the US that supplies to all the food places. They had 2 floors. Post-COVID, they said, all of our staff are working from home. We want to go down to 1 floor. So that's the real impact of those buildings. Healthcare is completely different. You're never going to have your dentist working from home and telling you to come to his house to do something in your mouth. And so that's where we've been very lucky. And in fact, over the past year, the leasing activity has been quite significant because a lot of the medical practitioners are now wanting to expand. They're not going to move buildings, hopefully. Most of them will want to expand their space in the building, and that's what we've found. So in terms of answering the question directly, the possible banking crisis is because of the exposure to office. The other asset classes, the money's moving into other asset classes, but moving away from office unless they pick up the office deals at an incredible discount. And that's where also the opportunity exists. If you can pick up any building that currently has a value of $300 and you're picking it up at $70 or below at a fraction of the cost, that's where a lot of the larger players made an absolute fortune after the GFC, the global financial crisis.
There's a comment rather than a question here from someone who's very uncomfortable. I personally think that the communication is generally poor it seems to me that we are not seeing what is going on overall, but it sounds like many issues. I see that happening in the new pot in a year or two, thus dragging down the overall return. I get the admin burden being reduced, but not the number of issue projects. I think it's good to just clarify what happened after Medical 26 that has not been repeated, because I can see the perceptions being created that there's major problem here, but something structural, something fundamental occurred at OrbVest. I think just from what I understand, for one thing, Martin, you now live and work in the US, which makes it clearly a lot more hands-on. But I don't know if that communication or that understanding is fully appreciated.
There are a lot of lessons we've learned. So the first thing is we've enhanced our capacity on the ground. We take direct control of the buildings. We are involved as the co-sponsor and the sponsor of the buildings, as opposed to in the very early days, we essentially handed the money over to someone and entered into a relationship with them. So we have direct control now. And I think with all of this, I think that you'll find that our communication has been very strong. The fact is, on the older buildings, it's been very frustrating for me because, you know, you're going through a legal process and you can't communicate. And every month the bank says, no, we're definitely going to give you a decision. And you're about to give a communication. And then all of a sudden they say, well, we'll defer it by 2 months. So in that situation, I hope people understand. But on a normal, typical medical building, where everything is pretty much as it's supposed to be, other than your dividend being slightly up or slightly lower in that quarter, I think our communication has been good and will continue to get better and get easier. Because if you think about it, Justin has to do between 30 to 60 reports every quarter, every 90 days. That's what Justin's been doing, because you have investors via the socials and you have investors directly in the US. That will essentially go down to 2, one in the US and one in the Seychelles, which you can see how it's chalk and cheese.
Justin, last comment from your side before we ask Martin to close off.
Yeah, Alec, I think, we are excited. We believe that a lot of these issues, I think, that have come up today, certainly, are, to a certain extent in hand. We are filling buildings. As I say, we're starting off at a base of over 90%, which means there's not a lot of vacancy to fill. So, I think it's actually pretty positive. What we do have to get control over is a lot of the expenses, and that is what the incorporation into the fund will effectively achieve. We're getting rid of literally millions of dollars of expenses on an annual basis, and you can do the math.
Martin?
I just want to end off and say thank you very much for having us online today, Alec, to you and your community. I think the one thing you've always seen from us is we don't shy away from the challenges. We're here for everyone. We've had our bumps along the way, as we've outlined today. But in terms of the overall medical portfolio, it continues to perform exceptionally well. I think it's a great investment for people. I think what you've heard today is, as interest rates went up, so expenses across the board and inflation kicked in, which put pressure on your expenses. But I think that's getting back to normal. And I think that for investors seeking dollar dividends overseas, we are here to help people take their money, invest it, produce dollar dividends, and return it to them. And we've got years of experience now, and the overall team has now been doing this up to 10 years in the United States. And so I'm proud to announce the launch of Accretive, the first real healthcare portfolio for South Africans. Thank you.
Just from my side to close off with, then, as far as the BizNews community is concerned, and we have been business partners with you now for a few years, after we became involved with you from Medical 26, are any of the other investments not paying dividends? 27, 28, 29, 30, up to 42. Are there any there that are having issues?
As far as I know, I can think of one.
Martin, there's Tampa 24.
Tampa is the one. It's Medical 37, and that particular investment, it is because of the one imaging person that couldn't get his license and he left. we are looking for a replacement tenant, and then it's back on track. And these are the reasons why specifically, you know, these individual tenants, when you've got 150 or to 200 tenants, you're always going to have minor issues along the way. But in an overall portfolio, you really shouldn't see major deviations.
So Magnus was on it, eh? He knew what he was talking about when he suggested put them together. Now it's going to be even more so. And so with Accretive, and when that kicks off, can community members who are looking for the same thing, really, can they now start investing there as well? Is that is that open for investing, or how does that go?
Absolutely open, Alec. We did our first, in fact, we listed about 3 or 4 days ago. So the first shareholders effectively are now listed in that entity.
And so that entity will have Medical 43, in other words, your 43rd building, and others that are going to be put into that. Well, in the next quarter, there'll be 5 more in there, and the following quarter, another 5, etc., etc. So if you're already invested and you want to get diversification, this is the way to do it. Am I reading this correctly?
Absolutely correct, Alec. Thanks.
Even though you're now buying in at 18 Rand to the dollar, rather than 14
Alec,
it used to be. Oh.
Alec, the interesting thing is that I was going to mention at some point, we're in a unique position where myself and your entire community are facing what's known as an election year. And we've both got very interesting candidates, ours in the US and yours in South Africa. But you know, the scenario is one's got to ask themselves the question, could the Rand get worse in the years ahead? We had the same discussion when it was 14. We had the same discussion when it was 16 and when it was 17.50. So I'm just saying to everyone that for most South Africans, they are all trying to find a simple, efficient solution to get their money out the country, to start to earn dollar dividends. And whether it stays where it is or whether the Rand gets worse, you still earn dollar dividends. They may not be 8%, they might not be 7%, but a worst case scenario, if they're in that range, it's a fine achievement for most South Africans. And I started this journey because I was one of them.
Martin Freeman, Justin Clarke, thank you for bringing us up to date and for the update on OrbVest today. Stu, before we leave, do you want to just tell us how we're going to be able to get hold of this video or indeed the information thereon?
Excellent. Thanks all for the webinar. It's great insight. Alec, yes, we'll get the video up onto YouTube as soon as possible. I know the team will be on it, and we'll always distribute it through the newsletter as well as a post-webinar email through Zoom. So it should be available to all very soon.
Thank you, Stu. Thank you to the other gents. Until the next time, I'm Alec Hogg. Cheerio.